All right, guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have Danny Riley of MrTopStep, and I know that we tried to do this webinar last week, I think it was, but we had some technical difficulties, so we moved it to today. I'm glad that everyone was able to come back and join us again today. So we kind of have a few specific topics that Danny wants to talk about today. Those include the transition from floor trading to screen trading. We also want to talk about program trading and algo trading. But I want to leave a lot of room. I think there's going to be a lot of questions just about trading in general, and I want to pick Danny's brain for a while. So I think the Q&A is going to be very informative, most of which will probably happen at the end of the presentation, but we'll also try to answer questions along the way. So definitely encourage everybody to stay tuned for the end after the PowerPoint. That's usually when we really get to have some really good questions and really good discussion, go back and forth and really learn and try to absorb the teachings that Danny wants to share with us. All right, guys, give me 1 second. I'll be turning things over to Danny. As you guys have questions, type them into the questions box. We'll do our best to get everyone's questions answered. The recording for the webinar will be posted on BMT sometime tomorrow in the usual spot. I will also share the link with Danny so he can post it on his site and to his followers. All right, guys, give me 1 second, and here comes Danny.
Thank you very much, Big Mike. I'm honored to be part of this today. You know, what we're going to do is we're going to kind of go back in time a little bit here. You know, I don't know how many of you guys know this, but today the Chicago Federal Reserve put out a study about algorithm trading, and they're going to be imposing new regulations on algorithms. But we have a lot to talk about here. We're going to really hit some stuff hard. I'm here to answer as many questions as I can for you guys, and I'm not going to kid you. If I don't know the answers, I'm going to tell you I don't know the answers. I don't pretend to know everything. I've just been around a long time. So what we're going to do is we're going to jump into my slides here, and hold on 1 second, and let's see. Okay, let's see 1 second here. That's not my screen. Hold on, you guys. I'm sorry about that. We've got it right there. Wait, we're a little bit moved forward. Anyways, here we are. So anyways, you guys, what I want to do first is I want to explain who I am. I know that there's, you know, that some people have heard of me and some have not heard of me, but I started out on the Board of Trade floor when I was 18 years old. I grew up in Crystal Lake, Illinois, with an Irish Catholic family of 6 girls and 4 boys, and quite actually, my parents owned a printing company, excuse me, right down the street here on Van Buren. It's 600 West Van Buren, and the Board of Trade is 141 West Jackson. So about 6 blocks away from my parents' printing company was the Board of Trade. But anyways, long story short, it was a family-owned business with uncles and aunts. For those of you who don't know this, Chicago used to be the printing capital of the United States, and Riley Printing was one of the largest printing companies in Chicago. But that was really not where I wanted to go in life. I wanted to try something different. My dad and my brother went to Notre Dame. By the time I got out of high school, to tell you the truth, there really wasn't any money to go to college. And one night after working at my dad's company, I ended up in a bar in Forest Park, Illinois, and a cute bartender by the name of Mary Claire Kane asked me what was wrong with me. I told her I didn't like working at my dad's company, and she offered me a job at the Board of Trade. The next day, I gave my dad a ride to work, and I dropped him off in the parking lot, and I started walking toward the board. And I just remember him yelling over to me, "Where are you going?" And I said, "I'm going to the Board of Trade." And he said he thought that was the greatest idea he'd ever heard. But anyways, let's jump into this, you guys. I know that's after the close, and I'm going to do the very best that I can for you guys today. Okay, what we're going to first do is we're going to work in a little bit of this transition from the pitch to the screen. Now, you know, the problem here is that when, you know, if you're a younger trader, you may not have known this. If you're a trader that's been around for 20 years, you would know a little bit about this. But there's a lot of talk about how the exchange is transitioning. But what we're going to do is we're going to talk a little bit about some of these locals and some of these traders and how they've transitioned. Now, the first part of this is when we were down on the floor in the S&Ps, and I ran one of the largest desks down there. I really was one of the largest desks on the floor in the S&P. We got an announcement made one day, and it came from the CME, and it came in the form of this ad that you're going to look at on the upper right-hand corner. That was the CME's first Globex ad. And prior to that Globex launch in 1996, many of these floor traders and brokers that were in these open outcry pits made millions and millions of dollars. And this was really when, being a floor trader was worthwhile, and, guys could take advantage of slippage between the bid offer and the S&P or any kind of those markets where big orders were being entered. Now, the pit below is the bond pit, and I actually came after the grain market. I went into the bond pit, and my roommate was Jimmy Carey. That's Charlie Carey, the director of the Board of Trade. And when Jimmy turned 19, he went from making $140 a week to filling Corzine's business at Goldman Sachs. That's how big it was. He went from making, almost nothing to making $40,000, $50,000, $60,000 a month and up. And it was a life-changing event. But as I remember, what happened most about this back then was that the bond pit held, like it says, it held over 600 locals, order fillers, and clerks. And when electronic trading hit, the CME and the Merc were kind of in a they're cross-town rivalries. And I don't know if you guys know this, but the Merc was always known as the Jewish Exchange, and the Board of Trade was always known as the Irish Catholic Exchange. And neither got along very well until Charlie Carey, the director of the Board of Trade, showed up over at the CME trading cattle, and that was how he met Terry Duffy, and that's how the two exchanges got together. But back in like 1995, when there was a big push to start getting this electronic trading going, the bond pit was still very robust. There was still a lot of people, and there's still a lot of people trading. But the Board of Trade came up with something called Project One, and I'm not sure, Project A, I'm not even sure if you guys remember that. But Project A was their electronic platform, and they partnered up with Deutsche, and they tried to form this new exchange that really never came to fruition. But the Board of Trade was just way behind in their technology. Even though they built this trading room that was boasted that you could fit a 747 wing to wing in that room. Exactly how you see it, you could fit a 747 in there. And right after they built the exchange, electronic trading came along. This is the new Board of Trade, or the new annex. The electronic trading came along, and as I said, the Board of Trade kind of stumbled. They went to the Germans to try to get their electronic stuff. It didn't work. And then they eventually, the CME bought, or in an exchange with the Matif, got Globex. Now, when they got Globex, they had to recode it and everything, and obviously they've done a lot of work on it. They've got hubs all around the world. But to tell you the truth, you guys, at the end of the day, the transition from the pits to the screen never really happened. It really didn't. Now, I'm not going to say that there aren't floor traders from the floor back then and floor traders now that don't trade electronically. They do. But the majority of you guys, the only way I can say this is to tell you exactly the way it was. Back then, if you had a friend, it didn't matter if you were a plumber, an electrician, a politician, you could get in there, and if you had a buddy that had big order flow, you could more than likely make money. Now, when I grew up with Jimmy Carey, he was actually became one of the largest bond fillers in the pit. He also, one of our other roommates was a guy by the name of Brian Henry, and Brian Henry worked at a company called Goldberg, and that was where Tom Baldwin showed up trading. And Tom Baldwin became the world's largest local in the bond pit, maybe the largest local ever in the world. And he started out with $5,000. He took some type of trading class in college, and what happened was Tom ended up at the Board of Trade trading bonds. Well, he traded through Goldberg, and in the first couple of days in the pit, Goldberg noticed that he was trading irregular size for the amount of money that he had. Now, very few people know this, but Tom went on to trade bigger and bigger, even though they kept telling him to lower his size. And then one day he had an out trade where he had a buy versus a buy. That would be where, if we were in the bond pit and I was an order filler and I looked to you and I said buy 50, and you looked at me and said, yeah, I'll buy 50 instead of selling 50, that's a buy versus a buy, right? So if the market opens way lower the next day, we both benefit from that mishap. Well, that mishap was the beginning of what started Baldwin on a long, long process of becoming the world's largest trader. And I got to know Tom personally, and I got to see what he did and some of his mistakes, and I've seen a lot of mistakes from these floor traders over the years. And, you know, to tell you the truth, you guys, if you're thinking about this and you go way back, obviously there was a lot of hoopla many, many years ago about all the money that was being made down there. And it's all true. You know, Joey Borsellino and the S&P and his brother Lewis, they'd make $1 million in a day, and they'd take their Italian friends out to a Cadillac dealership and buy 6 or 8 caddies. And then they'd all come to work the next day in the Cadillacs. But as we all know, the credit crisis and electronic trading really bore down on this. But when electronic trading was announced initially, it wasn't a very good thing for us, and it wasn't a very good thing for a lot of people that, you know, us meaning doing business from the trading desk, you know, open outcry. It wasn't very good news up for us, but we moved to options. And a lot of these locals that traded futures just disappeared. They either made a lot of money, they made enough to retire, they made enough to go trade electronically, but the majority of that really never really went online. It didn't. And they just didn't have the technology, they didn't have the wherewithal, they didn't have the knowledge. Some of these guys didn't even have like simple emails. So, you know, getting them to go on an electronic platform, and I'm not saying all of them, but many of them didn't even know how to do it, and nor did they ever even try. But anyways, the transition was going to be a tough road. And to tell you the truth, that picture up there of that guy, when I first started in the grain room, I don't want to make myself sound old, but that was really some of the equipment that was in the old grain room. Now, it wasn't exactly still being used, but that's the old observatory back behind that guy, and more than likely he's in the grain room taking orders. But as my presentation says, really, the trading floor community was shocked. Making millions was going to be a lot harder to do, and for the most part, a lot of these guys just disappeared. They took their money and they left. And as we went in, as we transitioned more into more electronic futures going online, more and more of these locals left, and many unhappy traders who thought that the floor was finished quit, and mostly and what the big talk about back then was, for years, I can't even express to you how long this went on, but for years, almost every day, someone would come up to us and say, oh, you know, you only got another year or two. You only got another year or two. And at a certain point, I even thought that we only had a few years left, but that was in 1996. We're 15 years later, and we're still thriving on the floor. Now, I'll admit that it's not as good as it used to be, okay? And a lot of floor traders down here will simply tell you that they make maybe 25% or a third of what they used to make. It's just not where it is. They came down there before because there was bit slippage between the bid offer, and now all that stuff has disappeared. But to tell you the truth, you guys, no matter what anybody says, I've always been on the customer side. I don't care if it's a 1-lot order or a 100-lot order. I've always said that it's somebody's money. And, you know, what happened with electronic trading was you got a lot more customer transparency. You know, guys, you know, you're actually able now to trade between the bid and offer and hit a bid and offer. And in the old days, when I took an order from, say, Marty Schwartz or More Capital, a big $12 billion hedge fund, or GLG or Soros, and they said, you know, Danny, sell 500. You know, I'd look in the pit, get a bid offer. I'd work to sell the 500 lot if it went well. You know, they'd show me the bids, sell 100. Someone would say, hey, 80 bid for 200. So I'd turn around, sell 200. You know, I'd get half that order done right away because I knew that if the market got away from me, I could sell at a lower price and my average would work out. But a lot of times, you know, it didn't work that way. And there was something in there called dual trading in the S&P, and this is really, you know, this had been, if you had ever dreamed about being a trader, it would have been back then, because the same order fillers that were filling our orders, buy 1,000, sell 1,000. Remember, back in the old days when the S&P pit, when I was in there, it was $50 a point, or 50. The multiplier was 50, or excuse me, 500, and that meant that for every 100 lot in the S&Ps, it was $50,000 per handle. So if we were doing 1,000 lot, it was $500,000 per point, per handle. And we did a lot of 1,000 lots and 2,000 lots, and I'll talk about that as we move on a little bit. But between the slippage and the front running, a lot of guys made money that were not skilled at all down there. So, you know, all that is gone now. And what I want to tell you guys today is that we don't have any advantages over you guys. We don't know where the stops are. No one knows where the stops are. This is all about learning and doing your studies and trying to figure out how retail puts in stops. And I think we're going to also talk about that in a little bit. But anyways, as people left the floor, you know, the prop firm said they didn't want to hire any of these guys from the trading floor. Literally, we heard this for years, that the new firms that were popping up in Chicago didn't want to have any of the bad habits of the floor traders. And I'm going to be honest, back then, with all that money that was flying around, there was a lot of stuff going on that probably wasn't, you know, wouldn't fit in a prop firm. Some of these guys were just too wild. They made too much money and, you know, had wild night lives and would come in, make and lose tons of money. Not exactly the way these firms operate today, nor do any of them operate like that today. But, you know, one of the things that people ask me about is, you know, well, what did happen in this transition to floor traders and stuff? Well, one of the firms that tried to do this was a small firm called Spike Trading. And it was run by a guy by the name of Anthony, and Anthony made a lot of money in the open outcry NASDAQ market. If you remember, years and years ago, there was a bunch of investigations where several traders made 10, 20, 30 million dollars in a short period of time. Well, anyways, Anthony left the trading floor and he went up and he formed a full clearing firm called Spike Trading, and it was on the 13th floor of the old CME. And what he did was he turned the whole trading floor, or the whole floor, into a gigantic electronic trading room. He went out to IBM. He fitted 50 different desks with IBM computers, set them all up with platforms, brought in all these floor traders. All these people would go up there. The cameras, everybody was in there recording. Look at Spike Trading. But at the end of the day, I think what these traders learned, and what you guys know by now, is that if you want to make the money, you got to do the work. That's just the bottom line. That's what Marty Schwartz has told me my whole career. You can't expect just to go up, turn on a computer, and get the same bang for your buck as you did in the pit. And a lot of these guys, they didn't know what moving averages were. They didn't know what, you know, RSI. They didn't know it. They didn't know anything. In fact, a lot of these guys that traded in the S&P didn't even know what program trading was, and that was going back in the 80s. So, you know, the bottom line here was, if I, you know, maybe somebody would say this differently, but in my mind, the transition from being a local on the trading floor to trading electronically, I'd say maybe only 20 or 30% of the people that actually made any money down there actually ended up going and trading electronically. So it was a big letdown for traders on the floor. But at the end of the day, like I said, we never wanted to see anybody's money get beat up in the S&P pit. We were fighting for the bids and offers, trying to make sure that the fills were right. But we were up against a gigantic war of locals and order fillers and clerks, and you know, it was a battle. It really was. It was a daily battle. I loved it, and I would never look back on it any other way. But I have to admit that I think that the transition is a much better transition for you as customers. It's made my life easier. We don't have to be fighting all day, and it's just cleaned things up quite a bit.
Hey, Danny, I've got a quick question for you. How many were a lot of those orders that you were filling, were they scalps, or were you looking at swing trades or day trades that were not scalps? Can you describe the types of orders you were filling?
Sure. You know, the first part of my career came over when I worked for a desktop trader by the name of Rick Barnes. And he was an old C&D trader, one of the first funds in Chicago, very well known. And Rick sent me over to the Merc, and when I got over to the Merc, there was something called broker groups over there, and these broker groups controlled those orders. Well, when we got onto the desk and we started executing these orders, they were mainly coming from institutions. We would do big roll business like for PIMCO. A lot of the S&P stuff, like if the Dow was really moving, like 200-300 handles, a lot of times we'd be selling futures to offset, as a hedge to long stock positions. A lot of times we'd just be big spec trades. But back in right around 1995, 1996, we had a account in our desk that was guy's name was Andy Chen. And Andy Chen traded it. He was a Chinese national with an Austrian passport living in Dubai. I know, it sounds crazy. But anyways, what Andy did is he opened up some accounts with us when we were at LFG. And one day he called me up in his very broken English, and he said, "Denny, this is Andy Chen. Please tell your people in the currencies to show more respect. I give you larger orders." Well, what that ended up doing, I went up to my guys in the currencies. I said, "What are you guys doing?" He said, "We can't even understand the guy. We're putting in 200 and 500 lots in the currency options. This guy's trying to put in 10s and 20s. We can't even hear what he's saying." I said, "Look, you got to give the guy the phone time. Do it. If you don't do it, I'm going to fire you." Well, after about a week or two, we got a phone call from Andy, and Andy, it was about respect and paying face. And anyways, Andy told me I did a good job and to look for a wire to come in. Well, a wire came in for $5 million. It was about a $50,000 or $100,000 account. And Andy started trading larger and larger. And then when he started making money, more money came in. And then Andy got a hold of me, and Brian Shepard and I ended up flying to Dubai in 1995. We started doing Sheikh Mohammed's business, and we ended up in the world's largest investment firm, ADIA, in Abu Dhabi. Now, we were doing Abu Dhabi's business, which was pure spec. They would come in and they would just bang the S&Ps around. Buy 500, buy 500, buy 500, and then market would move, sell 500, sell 500. It just nonstop going back and forth. And then we'd have guys like Tudor coming in, and Lewis Bacon coming in. Now, a lot of those big hedge fund guys like Tudor, Bacon, and Soros, they traded stock, but mainly they were there to trade the S&P. That was a big thing back in the mid 80s, 85, 87. I think you'll remember all that, and everybody was really pounding away on the S&Ps. But one of the big accounts that we handled, where we were doing 2,000 lots, and this was really, really interesting. We got an account from a company called Capcom, and Capcom was the old BCCI. And for many of you that are young and don't remember BCCI, it was a Middle Eastern trading company that literally controlled all the Middle Eastern trading. And they're a big bucket shop, and they traded against their orders flow, and eventually it blew up, and a lot of people lost money, and everybody got fined. But out of that, we ended up with the royal Saudi family's business. King Fahd actually came to the trading floor. The CME notified us through security, and they cleared out everybody. And they told us that there was a dignitary coming on the floor. We didn't know who it was, and that he wanted to come to our trading desk. So the markets are flaying around. Everything's going crazy, and up comes King Fahd with all his securities, M16s, everything, right up to our desk. I've got pictures of myself with my arm around King Fahd and with my partner Brian. But the long and the short of the story is that in 1987, about a month and a half before the crash, if you remember, and I think, Mike, you'll remember this. Remember when Tudor was talking, they were looking for the crash in 87, and they kept testing and testing, and finally they got it? Well, 3 or 4 weeks before the crash, I would get a call every day on the open. Now remember, this is $50,000 per point, right? "Hello, Danny. This is Bashir from Saudi Arabia. Please buy 2,000 big S&Ps open." Yeah, $1 million a handle. $1 million. Well, that was $2 million a handle on 2,000. So what happened was we were shaking the market up every day. And every day we would buy these 2,000 big S&Ps on the open, and then every day on the close we would sell those things out. Everybody in the room was watching this. We were the talk of the whole floor. I swear to God, No one had any orders like this ever. Salomon Brothers, Merrill, Dean Witter, Morgan Stanley, none. I had it all. And we were pumping all these orders through every day. But what happened was the royal family was actually short S&Ps. And what they would do, because before the 87 crash, the S&P was melting up every day, melting up, melting up, melting up. They would call me in the morning. They'd say, Dunny, what do you think of the S&P today? And I'd say, well, they're going to go up in the morning, and then they're going to sell off in the afternoon. And that was basically because every morning they'd buy those things up, and then every afternoon they'd come in and sell those things back out. But what they were doing, you guys, is they weren't really scalping. They had a core short position. And as the market went up and their margin calls kept increasing, what they do is they were short 3,000. Every day they would come in and buy 2,000, only leaving them short 1,000 during the day, and then they would come back and they would flip that other 2,000 back the other way to give them their core position. So every day for a month I did this. And to tell you the truth, when I talk about, plumbers and politicians and electricians trading, well, I lived in Oak Park, and I took the train. I took the L to and from Oak Park to the Merc. And one day on the L, I was sitting there, and some guy walks up to me, and he says, "Hey, do you mind if I sit down?" And I'm looking at him. I'm thinking, "Yeah, well, whatever." So he sits down next to me, and he's like, "I'm Larry." I said, "Hey, Larry, how you doing?" I said, "Do I know you, Larry?" He's like, "Well, not really. I know who you are." And I said, "You do?" I said, "How's that, Larry?" He said, "Well, I became an IOM member of the S&Ps back about a month and a half ago." He said, "And somebody on the floor told me every day at about 8:05 or 8:15, I should stand over about 10 feet away from your desk and watch what you do. And then every day at about 10 to 3, I should come back to your desk and watch what you do. And anytime you put an order, I should go buy or sell with you." So I'm looking at Larry and I'm thinking, okay, here's a guy that's front running. Everybody in the pit's making millions of dollars. The broker that we work for, Jimmy Place, actually took everybody out to dinner one night before Christmas, gave all the waiters Rolexes, and then took Brian Shepard and I and gave us a couple of Seiko watches. So that'll tell you how that cash was distributed. But we did a lot of that big business for years. It was earth-shattering business. But at the end of the day, what happened was about 3 days before the crash, I got a call from Capcom London, and they bought 3,000 S&Ps. And before that, what they did is actually, I'll tell you this quick story. And this will show you how the front running was being going on in the S&P back then. We get the order to buy 2,000 on the close, right? We've got about, they give us an extra, you can't fill 2,000 big S&Ps in 1 minute. So they give us like, 5 to 8 minutes leeway. Well, anyways, I get the call at about 2:45 to buy 2,000 on the close, or to sell the 2,000 on the close, right? So they give me the order. I look up at Jimmy Place. I don't want any mistakes here today. What do you got? I said, sell 2,000 on the close MOC. Well, they probably figured that these guys in Saudi Arabia and London, they saw the prints, they saw the fills, they knew what was going on. And one day they give me the 2,000 to sell, and at about 5 minutes to 3, they call me back up. They say, "Denny, please cancel, sell 2,000 S&Ps. So I yell into my broker in the S&P pit. I say, "Hey, Jimmy, you're out." He turns around. He goes, What are you talking about?" He goes, I got 400 of these things. So there's a 200 grand 400 lot, right? What do? They go over to Dean Witter and they buy 2,000. They catch Jimmy Place short 400 S&Ps. He loses $750,000 in 20 seconds, in a minute and 5 minutes. And he's at the desk kicking the phones off the desk saying, "We're going to London to kill everybody." But at the end of the day, a lot of these big orders that we were doing were spec, purely spec. Some of it was a hedge against stock. Some of it was a hedge against option positions. But 90% of it was all speculation. Well, anyways, so going up to I buy the 3,000 for the guys at Capcom London. On the day of the crash, I get a phone call at 9:20. "Hello, Denny. This is Bashir. If you get a phone call from Saudi Arabia, please don't tell them that we bought 3,000 S&Ps the other day." And I'm like, Bashir, are you crazy? I'm not doing anything like that. I go, they call up, they ask me if you bought 3,000 S&Ps. I'm telling them. He says, Denny, in this case, please sell 3,000 S&Ps. I don't care what anybody says, you guys. When we move this thing forward, I will explain to you how I helped the 87 crash and how I was instrumental in what was going on that day. But anyways, you know, prop firms didn't want us. We had to figure out what we wanted to do. A lot of guys just left. They didn't really have much background. You know, they got into other stuff. They took the money and they went into other businesses. Some guys stuck around. Some opened up firms. They're still around. But overall, the transition didn't go. It didn't go, and I don't care what anybody says. So anyways, my desk, we were the #1 desk in the CME according to volume, okay? And I was a give-up operation, and I was only there for about 3 years. But what that showed me was that the customers were tired of the bad fills, okay? And that's the bottom line. They would go anywhere they would if they thought that someone was honest and would give them the right fill. And we were doing stuff for a company called J.C. Bradford and a guy by the name of Doug Kitchen, and Doug ran the NFA's arbitration panel. And he always told people that the reason he came to us is simply because he cleared Refco and he got shitty fills at Refco and he got way better fills at our desk. And that's why Marty Schwartz came to us. So, you know, at the end of the day, I believe if you ask me what my success was, it was being honest, working hard, and making sure the customers got what they deserved and not ripping them off in the midst of it. Okay, so anyways, my desk was the single largest desk in the S&P 500 according to monthly S&P CME stats. At one point, I had 9 phone clerks. It was unbelievable, you guys. And I'm talking about fighting, spitting. One time, I got an argument with a clerk that was about 4'8". She worked for a Morgan Stanley broker. I'm just going to tell you these stories because you're going to shake your head in disbelief. But I gave her a big order to buy like 300 or 400 S&Ps, and I didn't see the broker moving. So I go up to her. I'm like, Cindy, what are you doing with the 400 lot? And she's like, fuck you. Excuse me. She said, I'm not, F you, I'm not taking your orders. Well, she had already had it for a couple minutes, and the market had already started going up. So I'm starting to argue with her. What does she do? She turns around, and she takes a pen. She stabs me in the hand, and while I'm looking up into the pit, she spit directly into my mouth. And I got called up on charges, and we took her on charges, and by the time I got into the kangaroo court, they were turning around and finding me for swearing at her. But anyways, we didn't react to that, the electronic thing. One, I was the biggest and the best, right? I know better than anybody. Electronic trading's not going to do this. They can't knock me out of the box. Well, after a couple of years of watching my volume go away and watching more capital move away and GLG and all the banks, and we did everybody's business, you guys. I mean, AIG, SocGen, BMO, Morecap, GLG, Goldman Prop, Merrill Prop. We still do all this stuff, you know what I mean? And the reason people say, well, how do you maintain that stuff? Well, we maintain it because we produce trading flow from the floor that these guys get every day. They love what we put out. But anyways, we moved the desk down in front of the S&P options, which I became a hated person for that because the big broker group that controlled all the options didn't want me down there. But the bottom line was about a year and a half later, we became second in volume in S&P options. My partner, Brian, and Suzanne Royals, who's worked for us since 1989, that's how long we've been around, a long time, huh? And they didn't want to do electronic trading. They didn't want to do options. And one day I just called the CME, and they moved my whole operation down in front of the options. You know, as far as the open outcries, what's going on in the S&P pit, you know, it's still going on. But what goes on now is traders in the S&P pit, they can bid or offer with their hands, as you know, and then they also have a handheld in their hand, or they have a headset on, or they have a guy standing next to them with a headset on, where they can offset their buys or sells in the ES. So even though there is still some trading going on in the big pit, it's really so small, you guys. You know, occasionally we'll get an 800 lot, 1,000 lot, you know, a 500. Somebody will, you know, on the cash close maybe something. But total volume in the S&P now, it ranges between, on a good day, maybe 15,000. And that's without your spreads. You know, right now you're seeing huge volumes in those front months. because it's all spread volume. And if you broke out program trading out of the ES and all that, you'd see there's no volume at all. Excuse me. But, you know, the thing was that it became a fair playing ground for the customers. And to tell you the truth, maybe it cost me and maybe I didn't transition to it well, but that's just the way it goes. You can't stop it. You can't stop technology, and technology rules, and that's what rules the trading floor today. So most of the floor population in the 80s and 90s is gone. Younger members trade electronically. Many members left the business, many older members. In fact, the funny thing was that when the CME bought the board of trade, we moved over to the floor. We were the S&P was the first contract on the floor, and there were guys in all the interest rate bids saying say no to the CME. Well, that didn't fly because the compliance department went down there and told them that for every day that they wore that button, it would be $1,000 a day. So those buttons went away right away. But it became a fair playing ground for the customers. It took out all that slippage. It made it so that you as a trader get to make a decision during the day to buy or sell at a certain price, and you're not going to get whacked out by 50, 80 cents or a dollar on some bad fill because somebody couldn't buy or sell at the price that they quoted. So right now, you know what? At the end of the day, this is what I say. No one ever told me this. No, this came from me. And what this is, there's only three kind of people left on the trading floor now. There's a guy at the desk like me that has the business. There's the order filler that gets the business in the desk. And then there's the local or the prop trader that takes the other side. That's it, you guys. And what I would tell you is what I've told my room many times, and I think this is really important, and Big Mike, I think you'll agree with this. The IOM seats that you can trade the CME S&P with were $250,000, $300,000 after the IPO. In the last 4 months, they've sold off from $160,000 to $50,000. Now, I'm not saying to go out and purchase an IOM seat, but Mike's got a big following here, and I'm sure there's a lot of good traders in there, and there's a lot of guys that pay a lot of commission. What you could do is you can come to Chicago now, apply for an IOM seat. The seat lease is $400. You pay $2,000 for the application. You come here, you take the test, you become a member, and you'll reduce your commissions by 70%. So of all the times ever that I would say if electronic trading is ever going to pay off for a lot of people, it's to go make sure that you're not paying more commissions than you should be. Because we all know at the end of the month when you trade size, you know, if you're trading 2, 3, 4, 500 minis, or if you're trading 50, 60 minis a day, or even if you're trading just 20 to 40 minis a day, at the end of the month, those commissions will bear down on your profitability. You made $8 grand trading, and you paid $4,500 in commissions. That's not going to work. And I think you guys really, I'll work with Mike on any way I can to give him the information. But that's a great idea, and I think that people that are trading actively, whether you're crude oil, SPOOs, any of these markets that are electronic, you got to get an electronic membership, or you got to go lease something and lower your costs. So here we go. This is where my background comes into play. First thing I'm going to admit to you guys is that I don't have all the answers, okay? And nor do I pretend to. I don't know anybody that does. But what I do know is that there's a new world order out there for trading. Since the credit crisis, you know, came into effect, we saw the S&P mini in 2010 or 2011 jump up to 5.6 million minis a day. We had a 10-day stretch in there where the S&P mini broke its old volume record of 5.2 million in a day, and for over 10 days did over 5 million minis a day, and for 4 days did over 5.4 million minis a day, and then made its all-time contract volume high at 5.56 million minis a day. Now we're not anywhere near that anymore. But my background comes from personally doing the UBS program trading business for 8 years, and I had both sides of the trades. Okay, so when you're doing an index R buy program, what you're doing is, or what we were doing back then, how index R buy programs work, is you take fair value, and a dollar under fair value is where if you get a dollar under fair value, and the S&P is cheap to the cash. You're bidding on the future and you're selling the cash, okay? And when you're doing a buy program, you're offering futures at a wider premium. You're selling the futures and buying the cash. Thus, index R buy program. Now, I had both sides of the trade. What that means is very simple. I've got the UBS program trading line in my desk, right? It's a direct line to New York. More Capital calls up and says, Danny, sell 800, not held. Sell 800 big S&Ps, not held. My first thing is I grab that phone. I scream into the guy, give me a bid. And he knows exactly what I'm talking about because we've done this routine 1,000 times, right? So say the S&P is 888 half bid, right? I say it's 88 and a half bid. He says pay 820 on 100, pay 780 on 100, pay 740 on 100. So it's 8 half bid, right? I know what he's doing. He's lining up his bids. He knows that I've got the futures and I'm going to whack his bids out. So he's got an advantage. He knows already that I've got the futures and I'm going to whack his bids out. So what he can do is he can start to hit the cash before I hit the program, right? So it's 8 half bid. I look at the pit. I go, sell 400 down to 8 even. I clean out the whole thing. It's 8. Now it's 780 bid. What's in there? 780 bid on 200. Sell 200 at 780. Boom, filled, and down goes the cash. But now, because I've got those other bids in there, I already know I've got more futures to sell. I just fill them. I don't even tell them. The stuff, I know my guy in the pit's already selling those 740s and 770s before they even go up on the board. Steve, fill. Boom, boom, boom. Down goes the cash, like you wouldn't believe. So, anyways, I met Marty Schwartz around 1985. He's a very good friend of mine. He's the market wizard. He's made huge amounts of money. And as much as I like him and as much as he's my friend, he has been an anti-program trading his whole career. He doesn't believe it's trading at all. Algorithm trading, program trading, this isn't trading, you know. It's not the way he does it. He does it at night. He used to chart 500 stocks. He traded the SPOOs all day. He came from the Amex floor. He knew that IBM was the bellwether. Somehow he got my phone number. Well, I can tell you I got my phone number. One day some girl walked up to me. Her name, it was his old clerk. And she says, I'm Susie. Can you call this Marty Schwartz? And I'm like, who the hell is Marty Schwartz? You know, I'm like, sure, I'll call him. I don't call him for a day or two. Next day, this girl comes back up to the desk. Danny, can you please? Here's Marty Schwartz wants to know why you haven't called him yet. Are you kidding me? Who's Marty Schwartz? I got Soros, Tudor, Bacon, UBS, Bank of America. I got every big account in the. Who's Marty Schwartz? Right. So this goes on for a couple more days, and then finally I get this phone call, and somebody hands me the phone. They're like, "Who's this?" And I pick it up. Hello. He's like, "This is Marty Schwartz. Are you ever going to call me?" I'm like, "Who?" He's like, "This is Marty Schwartz. Have you ever heard of me before?" And I was like, "I'm sorry, Marty. No, I haven't." He's like, "Well, then you better find out who I am." You know. So we talk for a couple minutes. Tells me to call him with some trade ideas. I don't call him. A couple days later, he's yelling and screaming at me again. "Why aren't you calling me?" Well, anyways, the whole thing about the guy's career was he was super smart. And this goes a little bit with today with what's going on, and in a small way with what's going on in the tech. You know, you got Apple up, you got the NASDAQ up 20%, 18-20% on the year, and it all revolves around the bellwethers. And he was very, very good at picking out bellwether stocks. He charted all these stocks at night. He'd come into work. He'd have a game plan. He would give me these channel lines. He'd say, if they get to here, they get to here, we're going to buy. We're going to sell. It went on all day long. But anyways, he predicted that the game would get ruined. And you know, in some respects, when you look at the volume, when 80% of the volume is program or 75% program or algorithmic trading, And, you know, if it's 1 million minis and 750,000 of that is program trading and the other 250 is outrights for like guys like you and I, we're up against quite a bit. I mean, and it's going to get worse. But anyways, you can see this chart. Algorithm growth has grown. It's a 2010 chart. It's a little older, but it shows the growth. And really what's going on here in the algorithm world is program trading ARB has drifted away. These big program shops like Nomura and Merrill Lynch, yeah, they still do program trading, but they don't make as much money as they used to. So they moved into the algorithms. Now, algorithms have become gigantically popular, as we all know, but they've also caused a lot of problems. You guys, and now I'm going to show you something. You're going to be shocked when I show you. And like me or don't like me, I wouldn't like to see anybody have this happen to them. But when we see this, you're going to be shocked. But what you can see is you can see that there's growth going into the futures. It's continuing. Now, this growth is not just it's not just in the futures, but algorithmic trading actually came out of it started in the equities, and then it moved into the futures. But anyways, we'll hit that. So HFT and the CME and volume. Well, you know what, you guys, here's the bottom line. I talked to Marty after the close today. He's the one that told me to look up that Chicago Federal Reserve story about regulations imposing on imposing new restrictions. He's right. You know, in some respects, it has run the game a little bit. But at the end of the day, what I'm going to tell you now is it's not going anywhere. You know what I mean? It makes up 75% of the CME's volume. They're not going to cut off their heads to spite themselves. They can't. It's just too big. They can't do it. There's no way. It's never going to happen. Can they put more restrictions on it? Sure. Are they going to stop it? If they do, the markets will seize. Well, maybe we'll go back to just doing 500,000 minis a day, and maybe people will be happy with that, but I don't think they will be. So where did all the volume go? You guys, I started running orders as a runner in the grain room, making $70 a week. I went into the bond room, and I worked for some of the largest traders in the bond pit, and I worked for 5 or 6 of those guys in the original Market Wizards book. Gary Beefeld, Tudor, Kovner, Bacon, Soros, Marty. You know, I worked for them all. And there's very few people out there like this, you know what I mean, that have as much history behind them as I do. I'm not saying there aren't other people out there. There probably are. But at the end of the day, I don't know who they are, and I've yet to meet them. But where did the volume go? Well, we were cooking along in 06 and 07. We weren't doing record volume. But in the beginning of 07, I was on the phone with Marty one day, and I know that he's a gigantic charter. And he said, Danny, it was a very key moment in my career because I guess I could say it. I'm not smart enough to remember everything, but in key conversations, I'm going to remember those very, very important words that stuck out. And what he said was, Danny, he goes, all the market leaders, the banks and brokerage stocks are getting killed. There's something wrong. I don't know what it is. He said, but there's driftwood floating around in the financials. And then he went on to tell me that if this continues like this, there'll be an enormous shift of wealth out of the United States. Now, these are the kind of words that a guy like me lives and dies for. I'm a street guy, you guys. I didn't go to college. I'm not, no silver spoon here. I fought my way. I fight my way every day. Nobody gives us anything. And down here, you know what it is? I learned this from a guy by the name of Harry the Hat. He was the head of the trading floor years ago. And after I started doing well, everybody started taking shots at me. I mean, literally, everybody would just give me a hard time, take shots at me. I went there, I was like, Harry, why is this? He's like, because when you get successful down here, people take shots at you. And that's where this is going. But anyways, where the volume went was really the credit crisis was instrumental. And I think that at the end of the day, this comes down to some very basic aspects of how people live and how they run their lives. You can't be losing money in futures when you can't pay your electric bill, and you can't be trading options when you're not paying your mortgage. And this extra money that people had back then, and there was a lot of it. We would see people. It was almost sad. I mean, we'd see people open up a $100,000 account, get long 20 S&Ps, and they'd blow out the 100, send in another 100, blow out the 100, and look, between you and me, you guys, look, the success of what we've done on the trading floor is not about that. We don't want any of that. We want to maintain customers that are with us for a long time. We discourage all that crazy junky buying and selling. We don't want to see that, and nor do a lot of people do that anymore. But one, where did the volume go? The credit crisis was the biggie. And then last year when MF Global pulled what they pulled, we were doing 300,000 options a month on the floor. After that, we went down to doing 10,000 a month. As of now, we're back up to 60,000 a month, and we're never going to go back to where we were, you guys. And then I'm not trying to be depressing. I'm not trying to – go ahead.
That actually brings up a good question I wanted to ask. So I've got two quick questions. I'll try to keep them brief. One, the other day, NYMEX crude down 400 ticks in a matter of seconds, but I also saw people saying that it had higher than usual volume. What do you think that that's because of algorithmic trading? I mean, we know it's because of algorithmic trading that it went 400 ticks in seconds, but what was the original trigger? Was it algorithmic trading? Some people said, they thought the SPR was going to come in, and what in your opinion, what actually triggered that wave of momentum?
Thanks for asking, Mike. The thing is that I'm very, very close on that, because what's happened with Marty Schwartz is I talked him off of trading S&Ps many years ago, and he's become the world's largest crude option trader. He had 41,000 crude options expire on Monday. And while that algorithm blip went through there, he lost $1 million on that. So do I know about it? Yes, I do. I did two things. One, I went out to Nanex, and I had Nanex run me an algo chart. And I'm sorry I couldn't put it up. I should have put it up. But basically, that was a gigantic algo blip. And what happened was there was talk about the U.S. going into their strategic reserves. And when that was found out that it didn't happen, what I think the crude was up on the day a little bit, and then once it started moving back down, what I believe happens here, Big Mike, is that once the algo catches the direction and it can sniff out the stops, it's a foregone conclusion. And once that stuff got denied about the strategic reserves, and crude had traded $100, it got up to a critical level, and in came that algo blip. Now, what I talked to Marty about today, and what we talk about all the time, is, I hate to tell you, but you may want to be prepared for more and more of this all the time. And when we move these slides forward, I'm going to show you exactly what I'm talking about. But I do. I think that was an algorithmic blip, just as I think that was an algorithmic blip on the day of the Fed when gold moved like that. Right. And I think that we have to be prepared for. Go ahead.
Yeah. It happens more and more, and it's going to keep happening. So the second part of that is you raised a good point. So in a world post-MF Global and post-PFG, do you think that we're going to see some type of an FDIC type of insurance for futures accounts? Or what do you think it's going to take for the retail person to feel more comfortable again about futures?
Great question. And yes, I do believe that there is going to be some type of a bank account. They're already talking about it. I actually wrote a story about this on the opening print back about a month and a half ago. They're already in negotiations to talk about trying to set up segregated accounts that would be set up. You open up your futures account with the clearing firm, but the wire never goes to the clearing firm. The only time the money is moved is when you need margin money or you're collecting or losing money in your account. But there's no doubt that after MF Global and what PFG pulled, that there is going to continue to be a big push toward that. Now, there was a time, Big Mike, back several years ago that was proposed, and they shot it down. So they already do have kind of like a template for it to do it. I just don't know when. But that's a great question, and I think that, what I would suggest, and I've always said this, and I think this, you guys should agree. I don't want to tell anybody you have to agree. But when you're picking a clearing firm now, and I can name a couple of, I don't want to say good ones or bad ones. We clear at Vision, but some people don't like Vision. We clear Vision because they give us a good rate, and we run our own operation. I will say that they've done a good job getting better. But at the end of the day, all these firms do the same thing. What you want to do is you want to make sure whatever clearing your firm you're at, one, doesn't have any foreign exchange risks. You don't need to be at a clearing firm. I mean, keep your notes here. You don't need to be at a clearing firm that's got some remote making prices for foreign exchange. For what reason? He's laying that off in the cash market, and right now there's still $1.6 billion missing from MF Global from all that. So, and OTC. Now, you know, like FC Stone is a great company. I have nothing bad to say about it. But I had lunch today with a guy that is an over-the-counter trader making prices over there, and I know that they run foreign exchange. So I think the best thing to do when you're opening a futures account, you got to get to a clearing firm that doesn't have that kind of stuff. You're gonna reduce the likelihood of a problem. But furthermore, if you're a really big trader, or you've got, and you don't really have to be a big trader. If you've got 50,000 or 100,000 in your account, tell the guy that you run the business through to put 50,000 in T-bills. You know what I mean? You don't have cash sitting in your account. Have T-bills in your name. You know what I mean? Now, years ago, there was a situation on the floor by a company called Stotler. Stotler went out of business. They did some stupid stuff. But when they went out of business, everybody that had money in T-bills got all their money back. And I know that it probably didn't work out that way at MF Global, but what was going on over there was something beyond anybody's wildest dreams. You know, a lot of these guys that ran MF Global were the very same people that ran Refco. And we all know what Refco did, and we all know how that ended up. So I guess at the end of the day, you know, I think that, yes, eventually that there will be an opportunity where a program will be set up where your money will be segregated away from the firm and their exposure. And two, the other part of it is go to a firm that you don't have any foreign exchange or over-the-counter exposure. Who needs that? You know, if you remember back in the credit crisis in 07 and 08, when Lehman Brothers was going out of business, there was something called Tier 3. Lehman was worth $2.4 billion, but they had $3.4 billion in bad debt. You know what I mean? So avoid all that kind of stuff. You can get to simple clearing firms, ask simple questions to your brokers. Do you do foreign exchange? Do you do over-the-counter markets? And can I keep T-bills? I think you clean up a lot of that problem. You know, who knows? I mean, I got to tell you guys, I'm a little shocked with what's going on here over the last year or so. I wasn't so shocked about MF Global as much as I was PFG, because PFG put out this big thing about how clean they were and all their due diligence. And well, that's another subject for another day. But I knew Steve Greenberg at Aileron. I knew Russ Wassendorf Jr., Sr., and to tell you the truth, we were the first website to go out with that story. We went out, we released that story. We did a global search on Yahoo. No one had that story up. We put it out about the suicide attempt. 20 minutes later, 200 stories up on Google. But anyways, now what we're going to do is we're going to talk about the new CME data center, and this maybe should have been on the other slide, but we're going to move this forward. So, program and algorithmic trading. You know, like it or not, it's not going away. Okay, and whether or not they come up with some new rules regulating it is, you know, we got to find out. Because at the end of the day, the New York Stock Exchange and the CME and all these, the BATS, all these different exchanges, if you take if you say program trading makes 70%, let's just say, let's be nice, 70% of their volume, do you really think the CME or the NYSE or the NASDAQ's going to throw out 70% of their volume? They're never going to. But anyways, the CME's getting ready to, they've already opened up this world-class data center. It's out west of the city. It's, you can see it, 428,000 square feet, 7 football fields big. And it's served by 238,000 volt transmission quality utility services from 2 separate generator plants. I've been out there. This place is a monster. It looks like something out of, it looks like something out of space, like out of a space movie, 2001. You know, everything is high computers, everything's buzzing and moving, and it's just unbelievable. But you know, to think that anything is going to change in this regard, it's not. It just can't. I mean, they're publicly held companies now, and I doubt very highly that the stockholders of these companies are going to say it's okay to drop 70% of what makes up their volume. And now this chart right here, this is the Nanex chart. Now Nanex is a company that we're partners with, and look, I think what we've learned about this in the new world trading order is you got to have all the tools that you can put in your toolbox. Nanix is great. They're great people. They've run a lot of stuff for us. They ran that gold stuff. And Mike, what I'll do is I'll forward you the gold stuff so you can share it with your guys tomorrow. But
Sure.
anyways,
And Eric from Nanix has done a high-frequency webinar on BMT too.
He's a great guy, and he's one of my contacts there. So you guys know him. But I'll forward you that gold stuff that he did for me. And then, okay, so despite the uncertainty, and we all know that there's an enormous amount of uncertainty out there. You know, we've always associated with a better stock market, a firmer stock market, with a good economy. Well, that doesn't work that way anymore, guys. The New World Order says that the S&P can be on its high while we're $16 trillion in debt with really no way out. I don't really, you know, I don't play the political game. I don't try to do that in my room. I'm sure Mike doesn't do that. But at the end of the day, I don't think anybody that became president was going to be able to undo what was going on in 07, 08, 09, and 10. You know, if you ask me, Bernanke did a good job. I don't know how else we could have come out of this, but at the end of the day, you know, the credit crisis has put a big crunch on the economy, and what's happened is we're seeing a big push into this electronic trading world. Now, if you look at this stuff, you know, you can see it's all coded. Interest rates have always been big in algorithms, and I wasn't even aware of that. But the big thing that's gone on here is that the New York Stock Exchange volume with algorithms is actually dropped. And what's going on is there's a big push now by all sorts of investment firms, whether it be a hedge fund, whether it be a mutual fund, an investment firm, also retail, a professional trader. Everybody wants to get into program trading. And what's going on is it's all moving into index futures, or into what I would say is mini contracts. And as you can see, it's continuing to grow and grow and grow. And now what you'll see in this next slide is it's, you know, well, this is where the demand comes from. And this is important because I think when you want to know who you're up against and who these guys are that are doing this, there's greater demand evolving in the marketplace is driving future demand, right? Well, who are the investors that are doing it? Well, you've got the long asset managers, you got hedge funds. We know that they've jumped on this bandwagon big. They didn't get into it real quick, you know, 5-6 years ago, but almost every hedge fund now has an algo program. Commodity trading advisors, of course, they're running electronic platforms and programs. They're huge into this now. Prop firms, gigantic. We know that all sorts of prop firms in Chicago are doing this stuff. You know, there's all sorts of different portfolio needs, you know, rebalancing your portfolio, exposure to different asset classes. So it's not just like, this isn't just being pushed into a little box into the S&P. It's going out all over the place. Electronic fixed orders, point and click, algorithmic trading, you know, the exchange development. Now, we're going to talk a little bit about that because the larger this crowd gets that moves into the space, you're going to need more liquidity. And with volumes dropping, that's kind of where I think this all comes in, is when you've got really big volume and we've got big bids and offer on both sides and the market's moving back, it's back and filling, rallying and selling off, back and filling. You've got all that liquidity in there. But when you're only doing a couple million, you know, 1.5 million minis a day, and you know, 75% of that is program trading, yeah, there's not a lot of liquidity in there. You know what I mean? It's and especially when a lot of these algorithms are all doing the same thing, just like the program traders are still all doing the same thing. So when it all piles up, there may be too much of that stuff piled up for the market. There may be too many of them out there for what the market can take right now. At least that's kind of what I think. The providers, you know, they're always going to be your FCMs. Technology providers, you know, it's like Ninja Trader, TT, those guys, they can set you up so you can start connecting, or, you know, your connections to the CME. Actually, there's a couple of platform companies now that can offer you, you can connect your program stuff right up to them, right into the Merc, right to the new data center. I think for as low as $250 a month, you can get level 2 data sent to you. So, you know, it's getting faster and faster and faster, and it's not going to stop. So liquidity pushing firms toward e-brokers. Okay. we know this. We know this as they move out of stocks, they're going to be moving into futures. And what are the things that they're most concerned about? Well, at the top of it is, like I just said, liquidity. Is there going to be enough of it? As they add more of this into the market, will the liquidity that's currently out there hold up the market for what they're doing? I don't know. And when you see, like I said, you're going to be shocked when you see this thing when I show you coming up. You know, broker and exchange connectivity, I don't think that that's a big problem. You can just about connect to any clearing firm right now if you've got an account and you've got the money to do it. You know, if you're a trading firm and you're trading decent size, every firm, every full clearing, that's a full clearing, FCM, full clearing member of the MERC. You know, that's where you get connected to. You don't get connected through an IB, and you don't get connected through a non-clearing FCM. You go to a full clearing member. So those brokers, they've got that down. I don't think that connectivity is a big problem. The infrastructure, I mean, we already know that the CME is building out that 7 football, you know, the size of a 7 footballs. You know, it's just a gigantic place to put house all their connectivity stuff. But it's gigantic, my thinking is how can you continue to expand that when you've got shrinking volume? You know, electronic reliability. I don't know. We saw night trading have a glitch. That scared a lot of people. Lack of trading color. Well, there is no really trading color other than the electronic blips that we got when things are getting out of hand. Functionality, I think functionality is not a big deal, and then you drop down to some of these lower things, reporting, bad data, stuff like that. I don't think that there's a big concern in that area. But here's the thing. This back on October 21st, 2011, in a minute period, they sent 6.65 million messages. It was a record. And what this tells me is that things have gotten out of hand. You know, I don't know, as much as the CME has advanced all its equipment and all the stuff that's being built over there, and they're the best in the world at this. They've got their infrastructure set up all around the world, and you know they've got it down. But you know, I get really concerned about this stuff because, and like I said, what I'm going to do is I'm going to push this forward a little bit. You're going to see why I'm concerned about this. But when you're pushing that much, when you're pushing that many messages through one, you know, whatever pipes you're going through to all these different exchanges, and something breaks down, what's going to happen here? I mean, we saw it at night trading. They lost what, $450 million in a few minutes. What would happen if we had a really big breakdown, and it was an industry-wide circuit breakdown, and everybody was stuck with their positions and couldn't get out? It would be $1 billion. So I don't know. You know, as the more they push down these pipes, I get more concerned and more concerned.
Hey, Danny, I wanted to ask actually real quick.
Here's where the game's going.
The 6.5 million quotes, and I've seen reports from Nanex that show, you know, say 6.5 million quotes and only, you know, 10 trades or something just so astronomically ridiculous. It's just incredible on some of the equities. That's, you know, that's a rigged market if by my definition. But I wanted to ask about what you just said, the flash crash. You know, the flash crash was pretty much everything you just talked about, except we somehow skirted the disaster at the end of the day.
Yeah, I'm going to hit the flash crash after this slide. And you're 100%
okay.
Right. I was the reason I think that this is going to be so important is I'm going to show you exactly what happened to me that day. But anyways, the game's quickly played in the, you know, it was played in the equity world, and as you can see, that's people going into the NASDAQ and people going into the NYSE and using HFTs to pick off money. And you know, you guys may know this or not know this, but Gecko Trading is from Chicago and run by a guy by the name of Steve Schuler. And he used to trade right over our shoulder. He could not trade the S&P for the life of him. But one day somebody came along and said, I got this little program that can pick off pennies on the New York Stock Exchange, and 10 years later he sells his company for $1.5 billion. So, but what you can clearly see here is that the profitability of this has gone down in stocks. And that means it's got to go somewhere, because you all know that money can't sit idle for very long. But here's the flash crash. Wow, this is hard. But anyways, what happened on the day of the flash crash? I think, and I'll be honest with you guys, we had 7 clerks at our desk. The desk was going along fine. Everything was humming. All of a sudden, the market started to shift down, and we knew that there was something wrong. But one thing I got to say here is I was interviewed by the CFTC that day, or not. I was interviewed by the CFTC about the flash crash. And because I work on the exchange, I have to be careful about what I say, okay? And that's just the way this goes. I can't be out talking bad about the CME, but at the end of the day, there's something called circuit breakers. And those circuit breakers, there was none around for that time of the day. And what happened was exactly what I'm worried about that could happen in the future, okay? And what Marty and I talked about today was we suspect that this is going to become much more often, whether it be in beans, whether it be in crude, whether it be in gold. It's just going to be wherever the crowd is shifting to that day, and there's that kind of stuff going on when the algorithms load up in there, and there's just too much of that going on. But anyways, our desk is located about 10 feet away from the S&P pit and about 2.5 feet away from the S&P options. And we had 7 clerks on the desk that day, 5 members and 2 clerks. And it was a normal day. We had done about 10,000 options, maybe 12,000. And then as we got in the latter parts of the day, the S&P started to plummet to the downside. Now, my thing is, we've been around so many of these things, you guys. You know, Gulf War 1 and 2. I was in Dubai and Abu Dhabi. I came back from the Middle East. 2 days later was 9/11. Okay, so I've been around all this stuff. I can't even tell you. I've been there for every major event. On the original 87 crash, we were the last desk on the trading floor to leave the CME. We left at 10:30 at night. But anyways, on this particular day, we were doing our options, and the market started tumbling, and I could sense that there was something wrong. You could see it in the premium levels between the cash and the S&P. The cash just started pouring lower, you know. And when you're trying to do these programs, you're looking for bids you're looking for bids to hit in the S&P, but the bids in the S&P evaporated. I mean, if you remember that, right, Mike? I mean, literally your ladder, the bid offer on the ladder was like almost blacked out, whited out.
Yep.
And we didn't even know what size was going through there. But there was a lot of size going through there. And what was going on, there was an investment firm in Ohio, I can't remember. And what scares me about this, you guys, is that you really, really got to sit down and think about this. You have these global derivatives books. They're called GED, JET, like Deutsche Jet, Global and JET book. It's a global derivatives book, right? It's a long short book. They hold stock, they hold options on the stock, and then they hold 50,000 minis as a hedge against the position. When the Dow closes up 2% or 1.5%, they cover some of those minis, right? And when the Dow is down 2%, they have to sell more of those minis to offset their hedge, right? I mean, very simple stuff. Well, that day, an investment firm had 45,000 minis to sell. What the guy was doing, and I'm going to be very clear with you guys about this, we do big orders on our desk. In the credit crisis, we were doing 10 and 15,000 and 20,000 lot mini orders, and we were moving the Dow 100 to 150 points every time we did those orders. I just hear the Globex terminal at the end of the desk going zing, 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 and then I look down, I look at John, I'd see the Dow popping. What are you doing? Buying 10,000. Now remember, we can't tell anybody in the pit, we can't tell anybody on the phones, we can't do anything, but we can just sit there and watch the market go flying up and flying down when we do this stuff. But on this particular day, when we got into the latter parts of the day, the premium levels between the S&P deteriorated. They just fell apart. I mean, to the point where you couldn't even do a sell program. So what happened was you had this big seller, okay? And as the Dow started to drop, it wasn't just this seller. Now, why that seller? I can tell you clearly that we can knock out 45,000 minis. It's not hard to do. We've done a 40,000 lot. We did a 42,000 lot. It didn't take that long to do if the market's there. I know that sounds like, oh, but really, you could do 42,000? How? Well, when we get that order, we don't get it at 42,000. The guy will call up and say, okay, work to buy 10,000, not help. So the guy at the end of the desk, John, who worked at Goldman Sachs Prop, who's a guy who I trust with my machine down there, he's got an MBA from Loyola, not like me. But John gets those orders, and he said, buy 10,000. And then he'll hit the machine, ding, 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 sold 10,000. He'll get the average. He'll take the average, paste and stick it, send it over onto the IM, shoot it back to the hedge fund, and then the hedge fund will call back up and say on a direct line, John, sell another 10, buy another 10,000. So we know how that works. But on this particular day, what I think happened was that seller, he either got the order late in the day or he sat on his hands, or he had to wait until a certain price was elected to start dumping those minis. I don't know why and how or what happened there, but he didn't do it right. He wasn't working the order. He wasn't putting them out. He started just flinging those orders in. Sell 5,000, sell 10,000, market, you know. And you'd say, well, can you really do that? Yeah, you can. If you've got TT and you've got the proper stuff with the CME, they can expand your limits. We had to have our limits expanded to 5,000 because when we do 10,000, what we do is we just have to close the screen and open up another screen and undo do another 5,000. Now we can do 10,000 all in one whack. But what happened on that day was the market started to Columbia in the afternoon. And it really didn't show up until like 2 o'clock. And we started to drift down by 2:15, 2:20, 2:30. There is no more. There are no more circuit breakers. So the market goes into a free fall. What happened at the end of the desk is we had a clerk down there that took an order from a hedge fund guy. He had a 3,000 lot S&P put spread on. And when he went in to buy the puts of the short puts he had on the other side of the spread, he bid up these puts. We quoted him 2,500, not 25 at 75. 2,500 at 3,500 even were these puts. At the end of the desk, this clerk buys 3,000 puts at 3,500 even. And after he gets that order done, exactly about 2:45, 2:47, the market starts going back up. I lean down, I look over at the desk. Is everybody okay? And during these times, we've been around for so long, we encourage our guys not to take big orders if you don't have to. And surely don't take an order from someone that you've never taken a big order like that from. If you're going to do that crap, you ask somebody at the desk what we're doing. Show it to us so we could say yes or no or whatever. But anyways, this hedge fund manager who had never used our desk other than to allocate to our own account ended up doing a trade where he did 3,000 where we were supposed to allocate it out to four other firms. Well, he pays 3,500 even on the pits and on the puts, and then the futures start rallying, and the futures continue to rally, and the futures continue to rally, and by 4 o'clock, the SPOOs are back up almost, to pretty much a little lower from where it started out, but most of that loss was gone. And I got this guy on the phone telling me, hey, Danny, I got a problem. If you can't get those 3,500s, 35 evens down to 25 even, I blew out my entire fund. And I said to the guy, I said, what are you talking about? I said, what am I going to do? Go into the S&P option pit and ask these locals to reprice $10 on puts you bought? I go, it's never going to happen. The futures have already rallied. He says, well, I hate to tell you, Danny, but I'm going to be leaving you with a $2 million loss. And I just fell off my chair. I couldn't believe it. And what it also did is it left a bunch of losses in other firms. And the whole total loss ended up to be about $6 million, $7 million, which our firm ate. We ate $2 million of that, $1.8 million of that. The guys at our firm ate the rest of it. But at the end of the day, this is real. And this screwed up my whole life. This ruined 32 years, 31 years worth of working and what I believe was doing the right thing for customers the whole time. I don't have any fancy cars. I've never bought a brand new 100,000. I don't do any of that crap, you guys. I don't go expensive vacations. I live in Old Town downtown with my wife and my daughter. It blew up everything. took away all my retirement, took away all my daughter's college education, put me on the ropes for my house. You know, things that I thought I had locked up, lock, stock, and barrel, no problem. Walking out of here 33 years later with a couple $1,000,000 in my pocket. Hallelujah, I did it. You know what I mean? And then all of a sudden this stuff. And this ends up going into a big arbitration case where the CFTC and the CME clearly said that we were 100% in the right. We never did a thing wrong. We did everything according to the CME. Timestamps, you know, we didn't fill the order. Another broker did in the pit. We don't have brokers in the pit because I don't believe that when you're filling these kind of orders that if you got your buddy in the pit filling it and you get a crappy fill, that you can go to your buddy and say, hey, you know, you got to cut a check for 20 grand on this order. Because if he's my buddy, more than likely I'm getting a kickback, and we don't do that crap. No kickbacks going on at this desk. Never have been, never will be. But at the end of the day, that knocked me out of the box. But what I would say is we've fought our way back. You know what I mean? We've gone from absolutely zero to paying most of this off to starting to make money again and starting putting money away. But I'm going to tell you, you guys, this whole thing scares me. And when you see what the Fed gold did on the Fed day, and when you see what crude oil did the other day, I mean, come on, there's instances of this stuff going on all the time. But as traders, we're only concentrated on the markets that we trade or the ones that are in front of us. But I can assure you that this stuff goes on, and you know, there's probably different blips every day of the week. We're just not looking at it.
Right.
A place like Nanex could show it to us, though.
Danny,
but anyways,
that's a very painful thing. I want to ask briefly. So, you know, a lot of trades got busted that day. How come yours didn't?
Well, see, the thing was that that trade was a trade made. You know, some of those trades that were busted, they were questioning whether they are actual trades or just prints on the board that never existed. You know, we knew going into it that we were in trouble, and we did our very best to make sure that we let everybody know that we did the right thing. We didn't try to stick anybody. What the fund trader did was, when he knew that I wasn't going to go in the pit, and he knew that I was willing to stand up and take the $1.8 million hit, he called the other clearing firms and said that we screwed up on the fill that cost him his hedge fund. So what happened, some of the other hedge funds, Rosenthal Collins, didn't pick up an extra 400, and that left us with like 800 or 900 of 3,000, which cost us, you know, almost $8 million. But no, we were not. We were hoping that we'd be part of that, but I don't think they could have done that, Mike. They you know, a lot of that stuff, they were taking stuff out in stocks. I think a lot of that stuff that was taken out was in the NASDAQ, wasn't it? Or was it the CME too?
I really don't remember. I'm just ashamed that happened.
Yeah, and you know, the thing is, what I always say it like this. It's like what I started out the webinar saying. It doesn't matter if it's a 1 lot or if it's a 100 lot. It's somebody's money. And when this kind of stuff goes down and there's nothing that you can do about it, and that's what I'm really worried about, is that as you move forward with this and volume slips away from these markets, you're just going to be loaded up with all these programs, and you know, you at any time you can get hit with this. I mean, here's Marty Schwartz yesterday. He's got 41,000 crude options. He's going to collect $1 million in 30 minutes. He's collecting $1 million. The crude just stays where it's at. Everything's fine, right? You don't see anything abnormal. And then all of a sudden, in a 3-minute, 4-minute blip, crude drops $4. He loses $1 million in 20 minutes. So, you know, for a guy like him, he can afford it. But for guys like us taking big hits like that, you know, that could mean everything we've got. It could mean us being out of the game too. You know, so I'm not really sure what the solution here is. I think that they do have to.
Yeah, I'm sure that you've seen a lot of things in your time. You know, people that can't handle it. Wasn't there a story about a guy that was robbing banks in order to fund his futures account? All kinds of stuff. You know, but some really sad stories too.
Yeah, and there was actually a guy years ago that I don't know if you remember this. They traded bonds through a company called Lee B. Stern and Company, a well-known guy in Chicago, owned a soccer team years ago. And these guys, they went in, they applied for memberships, they got on the floor and traded their own accounts. And then one day they decided to put on makeup and beards and long hair, and they went on the floor and they bought 30,000 bond options, you know. And then when everybody found out that they had bought these 30 or 40,000 bond options, they knew that they were going to have to sell these things out, so everybody started selling bonds, you know, to front run the, you know, but it goes on forever. But to tell you the truth, Mike, there isn't as much as that anymore, and the CME's really done a good job on slapping down on that. But my main concern isn't so much what's going to go on the floor anymore, it's what's going to go on the screen. I'm concerned about all that. But anyways, you know, what we'll do is here, you know, MrTopStep's got a couple of quick trading rules, and you know, some of this stuff was built up over the years, and one of the rules that we use, and this is something that I made up, and I redid this rule when I saw it on the website, because they didn't really make it, they didn't make it up right. They wrote a bunch of stuff that I didn't write. But after many years of doing the index arb business and the S&P program trading, I noticed that after the S&P moves in about 10 handles, it actually does. It moves in 10 handle increments. And what I think, we can read this, but for example, the S&P opens at 1194, down ticks to 1192. If that's the actual low, we feel strongly that if the S&P is good, it's going to move up to 1202. And we believe that the S&P moves in 10 handle increments, but also those increments become inflection points. A lot of times after the S&P has moved 10 handles, you may make a top or you may make a bottom. But what this really has to do with is, it's really got something to do with taking the retail from short into a decline to long into a rally. You know what I mean? Once the retail gets shorter, once everybody, the pit, the retail, the crowd gets short and the S&Ps come down a little bit and stop, what the first part of the up move will be where the retail has buy stops in. And the buy stops will elect the offer side of a buy program. It's kind of like musical chairs. Once the stops go in, the offers of the buy programs go in. The buy stops elect the offer side of the buy program that lifts the offer side that makes the buy program. So once you make a low, you get that 2 or 3 handle bounce, and then you'll get up toward where the retail puts their stops in. If the premiums are wide enough for a buy program, what will happen is you'll continue up. But a lot of times what will happen is you'll back down and you'll retest, and if that retest holds, then we really know. Like, there's many times where I'll come out on the IM, like back a couple of days, well, I don't want to say the 1395 level, but there have been many instances where I'll come in and I'll see the certain price action that I'm looking at, I'll see the fair value, and I'll see the program levels lining up. I know that everybody was long, got short into the hole, and I know that there's buy stops above, so I know more than likely that once the market starts to short cover a little bit, in come those buy programs, and that's when we start looking for our 10 handle rule. But this is a rule. I know that it may be hard, but what I would say as a trader, take out everything in here that you're reading, but just look to see how often the S&P makes a 10 handle range. I think Mike and I talked about this before. He said he looks at it. The S&P does tend to make a 10 handle moves. Now, those are great trading days. When you just get a 10 handle move, you can buy and sell, and you can trade the range. It's those big outside days when the market keeps going up that the 10 handle rule doesn't work.
Well, I've seen,
and these are just some of the things that Marty.
I think when it comes to retail, right, I see two different things when I'm looking at people on the forum. I see people get beat up in what they would call chop because they have their stops too tight. So as the market is, barely moving, they're getting taken out, and they keep trying to sell or buy extremes, and it just, reverts back and they get chewed up. And then, of course, the second scenario are strong trend days when they just keep counter trending over and over and over. They just get blown up because the market won't stop. The market, barely pulls back any. And I mean, it's really hard. But I think that in general, I think that most of retail puts their stops in very predictable places. That's kind of what you were just describing. You can kind of see, all these stops are going to be at a certain level, and the market is obviously going to be drawn to those levels. And that kind of goes into the 10 handle rule, right? Because when I look at it, people think, okay, the market's going up. And what happens is we'll end up going down just enough to take all the weak hands out before we continue higher.
Yep, exactly right. There's so much psychology behind that. And, look, the reason part of these rules exist is because when the desk was really busy and it had all those orders, we had a thing in the desk. We would do a lot of retail, or we would take retail business because retail always trades. You're big institutional players, and if we have a lot of them, obviously they're always trading too. But there are certain days when the big guys don't trade, and the only thing that's trading are the retail guys. And what we figured out was when we would look at this, we would see guys, sell 10 big S&Ps at 91 even and say, hey, pay 93 on 10 stop, or guys would use 2 and 3 handle stops. Well, after we looked at that on the desk for so many years, we figured out that, look, up 3 handles off a low, 3 handles above a high, 3 handles below a low, you're going to be hitting these kind of stops, and you definitely can trade around this stuff. But we do believe that once you get the shorts to get long into the rally, you come up to a 10 handle inflection point, you're more than likely best off taking some profits and maybe stepping back a little bit, or even going the other way. But you're right. What I think, Mike, is what's happened. Somewhere along the line, these guys that are writing these algo programs, they've talked to guys like me, or they know people that have retail books, and they know exactly how these stops are put in. Now, they don't know where the stops are, but someone has, it's obvious that when they're writing these programs, that someone has come up with the idea that, hey, retail uses these 2 and 3 handle stops, and this is what these systems feed off of. So, it's disheartening to see, but that's really how the markets are working.
I've always wondered, you and I, we only see 10 levels, but the market makers see the entire book. So at what point does that information make its way, into a algo that literally can see those magic levels where the numbers, make it very pronounced that that's where something is hiding out.
Absolutely.
And I wanted to ask also, so, the majority of people on the forum are futures traders, and I want to ask you just a couple questions. Do you think that there's a thread on this on the forum, and this is why I want to ask you this same question that's on the thread. Do you think that you can be profitable trading simple directional trades in futures?
The answer to that is yes. But what you have to do now, and it's got a lot to do with all these programs. I know that this sounds funny, but you have to expand your levels. You have to be much more patient. What happens now is if there's, one of the things that Marty Schwartz has taught me is that programs, you can tell when you're going to have a trend day, and you don't need anything special. What you look for is you look for your cash to be up every half hour. If your cash is up at 8:30, your cash is up at 9 o'clock, your cash is up at 9:30, it's more than likely there's somebody out there, a mutual fund or somebody who's got an agenda, they're buying cash. But what I really believe is that futures traders nowadays, if they take a back seat to get it, just because you got up at 7:30 in the morning, just because it's the 8:30 bell, that doesn't mean that you're supposed to hit that platform, start hitting on your keyboard. What I've learned, you become much more profitable by trading less and really, really being patient. And I know that sounds like weak advice, but at the end of the day, guys that are hurrying to get in the S&P now lose. Guys that are waiting and waiting and waiting for the levels to come, they make money. If they're jumping the gun, or they move out of the way or get in before, they lose money. But I do think futures traders can make money trading this on a daily basis.
Let me ask you, do you think that people that are long 1 minute and short the next, and then long and then short, does that work? I mean, truly scalping, right? I mean, they're long and they're short.
I don't think that does, and no one really does that anymore. They don't even do it in the S&P pit. What's so stupid about the guys in the S&P pit? These guys used to hold on to stuff for as long as they could. Now they buy 97 halves. They're selling 98 evens. They make less than a lot of off-floor traders now that know how to hold on to things.
Well, you'd be surprised. I see a lot of people on the forum that do it. A lot of people are, 5 minutes they're long, and the next 5 minutes they're short, and they're long, and it makes my head spin a little bit.
Right, and I think for those guys that are trading like that, they should try it the other way. You know what I mean? Take a different approach to this. Some morning, get up and say, look, it was like that retest of the 1395 level back a week and a half ago. To tell you, I swear to God, I went out on the IM. I said, I don't know if it's going to hold here at 96 or 95, but we're going to hold here. And but if you had bought them, they were 01, 02, 03. If you had not waited for the S&P to run those stops through 1400 even and then retest that level, and you were buying, you lost all the way down. So, that's another thing that Marty and I have talked a lot about. It's really important when you're trading now, and we believe this wholeheartedly. Buy into those sell stops. Let them run the sell stops and then buy them. Let them run the buy stops and then sell them.
Right.
But your patience, you know what I'm talking about. Your patience level, you'll find out that once they bonk out those stops, they usually go the other way. So we really believe that if you wait, you let them run the stops, you get a better entry.
And I also wanted to ask, do you think that there are two different personalities, like a morning personality and an afternoon personality of the market?
Yes, there's more. There's more people playing in the morning, and what happens is if you're a global derivatives book, or you're a hedge fund, or you're a prop desk in New York, and these guys run what they call long and short books for stocks and stock options. So they adjust with their futures. If they come in with a bias to the long side and the market goes up, they don't have to do anything, right? So they may trade a little bit in the morning and get their position skewed correctly, and if the market goes their way, they don't do anything in the afternoon. A lot of times when the markets pick up in the afternoon is when the market's moved against a lot of people and they have to adjust back into the latter parts of the day. But to tell you the truth, I never believed in this. There's a book written by a guy by the name of Charlie D. Francisca. He was an old bond trader, and he died of cancer. He was one of the best-known bond traders next to Tom Baldwin. And Charlie used to run a class at the Board of Trade. Very nice guy, exquisite guy. And he would go from Northwestern Hospital on chemo. They'd pick him up. They'd bring him to the bond pit. He'd trade till 11. He'd go back to the hospital. If he felt okay, he'd come back and trade the close. But what he did was he ran these classes at the Board of Trade, and they were for free. Every day at 7 o'clock, you could go into a little classroom at the Board of Trade. There'd be 30 or 40 bond guys in there, and they'd be all listening to Charlie D. The book is actually called Charlie D. And if anybody's out there and you want to read a really cool book, it's great. It's about, about the gentleman, about how people actually used to trade. These guys in the bond pit, they were much more gentlemanly than the guys at the S&P pit. But anyways, Charlie held this trading class every morning, and I remember being in there one morning, and excuse my French, but there was this little Jewish guy. His name was Schwartz, like Marty Schwartz, in the back of the room, and he kept waving to Charlie. And finally, Charlie looked over and says, "What's up? What do you ask?" He said, "Well, Charlie, what do you think about a guy that comes in and trades, for the first hour and makes $2,000 and leaves?" And I knew Charlie traded all day, So he looks back at the guy and he says, "Well," he said, "first thing I'm going to tell you is you're never going to be a millionaire." And everybody started chuckling. And back then, I really, really believed, Mike, that if you wanted to be a trader and you made money in the morning and you could keep it going, you could trade all day. But now I believe if you make money in the morning, I'm not saying to stop trading, but holding on to profits more, holding on to your profits now is just as important as, getting into the right trade. I know it sounds funny, but they go together. How often are you going to be able to make a good trade? How many times in a day are you going to be able to do that? Now, I used to believe that, and there were times back when I was trading at the old CME, I swear to God, I'd be up $80,000, $90,000 in the first 20 minutes. And far be it from me, I'd never made any kind of money like that. I should have been booking those profits and walking out the door. Instead, what do? I stick around all day, and by the end of the day, I'm down 40 grand. And I've traded, 900 S&Ps aside. So when I look back at this now, I think based on the way the markets function, the way all this blow-up stuff that's going on now, hey, if you can get in the morning and you can make your number, there's nothing wrong with just sitting back and paying attention to the markets and leaving it alone.
Right.
What I do know is that what I do know in the old days is if I was down 10 or 20 grand, I could trade around that. I could buy a 6 lot, buy a 10 lot, sell a 10 lot, sell a 6 lot, and sit there and make back 10, 1,500, 2 grand at a crack. But now when you're down and the markets are going against you and you're down 10 grand and you're like, hey, you know what? I'm down 10 grand at 10:30. I'm going to come back, I'll take a break and I'll get this 10 grand back. There's no way to do that anymore. You're lucky if you get that kind of treatment. These markets aren't as easy as they used to be, and they're very unforgiving. Back in the old days, we could trade in and out of losses all day. Now, we get hit by an error, I get right out. If we got bad trades on, I just get right out. There's no holding on to this stuff. You just lose everything you got. And to tell you the truth, there isn't a trade. There's never a trade that we do that we don't have a stop in. They're got to follow up with a stop. God, it's like if you want to learn to trade another day, you better have your stops in. And so I guess the answer to the question is I don't know. I find it harder now to trade in the afternoon. A little bit easier in the morning, but sometimes there's some perfect setups in the afternoon also. And like we follow those cash imbalances every day, which I'll get on the thread and I'll start sending you the imbalances. But sometimes the markets will be weak in the afternoon, and all of a sudden we'll get $1.2 billion to sell in the afternoon, and the S&P sells off another 5 or 6 handles. So yeah, there are some good trades in the afternoon, but I really think the way that things are set up now, if you can make your money, take it and run.
Right. Before I ask more questions, I don't want to interrupt. Do you have more slides, or was this the?
Well, we've got this last counter trend. Do I have more slides? Oh yeah, well that's a little bit about MrTopStep, but we'll do that later. But listen. The one thing that I think is important about this, Mike, is I've learned a little bit from you, but I had already learned a little bit prior to this that I love trading for the sake of trading. I wouldn't get up at 4 in the morning, work on the floor all day, run all over the place, and come in here for a couple hours if I didn't like it. And I agree with what you talked about to me. It's not about selling my product here. It's about spreading the word. It's about trying to give people a feeling of what we're seeing, what we're doing, what helps us make money. It's not about selling things. So the way I see it, we've got that last little slide. It's a little bit about MrTopStep. It doesn't sell anything, but let's take the questions. And what I'll say before I take all the questions, or if there's more questions, I can tell you honestly, I don't know all the answers, and I don't pretend to. What I do pretend to know is that I'm there every day, and that I think that over a period of time, over years and years of me being on the floor, I've developed something that's called pattern recognition. And this has been told to me by Marty Schwartz and a couple other good traders. I don't necessarily follow charts or moving averages. Yeah, if you're going to tell me about a 50-day moving average and we're getting close, or obviously 200-day, 100-day, that kind of stuff. But at the end of the day, 99% of what I do is all gut. It's all looking at the boards. It's all following the difference between the cash S&P and the futures. It's all in the premium levels. It's how they're setting up buy and sell programs. It's on the half hours. It's what flow that we're looking at during the day that helps us kind of determine whether we like the markets or don't like the markets. So,
right.
I may not have all the technical questions for your answers for your guys, but I'm surely up for answering anything I can.
Well, let's do this. Go ahead and put that last slide up so everybody has your contact info, and then I'm going to say anybody that has a question, type them now. And I've got a couple questions that I want to start with. So one,
okay, cool.
What do you think about Stottlemyre and Dalton and market profile? Obviously, my understanding was it really got its roots from the floor. So does anybody use it? Do you use it? What do you think about it?
Peter Stottlemyre is real. Market profile is real. What we've done is we've got a guy that has a sheet on the trading floor. He puts in a little market profile. He puts in 3 or 4 different stuff, and he's put it all together. But definitely one of the things that we do look at is volume levels and market profile. Peter Stottlemyre was, I believe, and tell me I'm wrong if I'm wrong. The guy's a genius. He was around the Board of Trade years ago in the grain room, and I actually knew the guy that worked for him. His name was Kevin Coy, and my cousin Kevin Riley actually worked at for Stottlemyre. And even today, you know, in this high volume, high frequency world, there are times when, you know, you hit these volume levels in the S&P or in some of these other markets, and they bounce right off of those things.
Right.
Like yesterday, I think the volume yesterday level in the S&P was it 58? 58 even? I can't even remember all the prices. But it kept it was the close and the volume level yesterday. So we continued to look at that all day long, and all day long the S&P bounced off that 57, 58 level, you know, and then eventually sold off late in the day a little bit and then bounced back up.
Right.
But yes, definitely Stottlemyre, that's a great tool.
I'm a big profile trader. I don't know if I told you that or not, but
no, you never did, but now I know.
I wanted to see what your input was.
No, he's great, and to tell you the truth, that's one of the that is a really, really cool way to teach people to trade too. You know, if you're learning Stottlemyre, there's more to it than just following the volume levels. But when you learn that technique, it's a great style of trading, and I think it also limits a lot of your risk when you're trading off those volume levels too. Am I right?
Yeah. Well, I found myself, you know, years and years, I went from scalping now to longer term trades, and I find that I need a way to frame the market. It's not necessarily that the value areas or the point of control is some magic number, but it gives me a concrete way to really, you know, the context that I need to frame the market. You know, I learned a long time ago that there is no such thing as some type of a magic number, but you have to have numbers somewhere. You have to have levels somewhere that you use to base your trades off of. Yeah. And those numbers, those levels, you know, they make sense to me more than anything I've used in the past, so I really like it. So my next question, then I'm going to start asking some of these from the members. QE3. You know, I put out a little graphic on Twitter with Helicopter Ben throwing down his money, and the little saying at the bottom was to infinity and beyond with Buzz Lightyear. What's your thinking? Because I was kind of thinking, first of all, I was a little bit surprised that he did it this year ahead of the election, but that's all in the past now. I really think that we've been rallying so much that a lot of the QE3 is built into the market, and I was expecting or am expecting some type of a correction and sell-off. What do you think? What do you think is going to happen?
Well, you know, I agree with you what you said. You know, the Fed probably would not have stepped up to the plate as quickly as they did, but the ECB kind of gave them a signal that they were going to step up, and if you're going to do it, you have to do it in tandem, and they did. This QE3, if you read, you know, I'm sure you did read about it, it's kind of a QE3 plus. You know, they've got some extra tools in there, and you know, the fact that they're going to be buying, you know, more mortgage stuff, and I think it's going to continue to support the market. What I will say is I did think about 2 weeks ago that you could sell the news at some point, and that was completely wrong. What I think is going to help carry the market continue higher now will be kind of a support from that. But I do agree with what you're saying. I think anywhere in here, whether it be, you know, 1450, 1485, 1475, we can have a 100 handle pullback. But right now it seems to me that they're really, really keeping this very tight, almost like they've got another leg up or something coming our way.
So, okay.
In the recent price action that we've known.
Sorry, go ahead.
Well, go ahead.
I was going to say, so that you would just continue the motto of don't fight the Fed.
Well, I don't want to fight. Look, I want to play both sides of the market. There's a little saying that we have over here. We want to be long. You know, we don't want to fight City Hall. If the market's going up, we want to be long. If the market's going down, we want to be short. But the bottom line here is it's been hard to be short these foods. And I do think that as we go into October, you know, September's got its scary stuff statistically, and then October, you know, you get some scary stuff, and then you got the election. My own gut feeling says that Obama's going to get elected. And again, I'm not for or against. I thought he was going to win a landslide vote in his first election. I wrote about that 4 months before the election. But I think what's going to happen here is, Mike, is it's a little bit outside the QE, and it's a little bit outside the election. It's really It's really got something to do with people or investment firms that are not fully vested or not long enough in the stock market. And as we go into the last quarter of the year, and you've got the S&P up 14%, and you've got the NASDAQ up 15%, all these naysayers that have all this money on the side are more than likely going to be pressed into buying some stock. So I think there's probably more, but I wouldn't doubt, the way this thing goes, that we could wake up in the morning and this thing could be down gigantic one.
Right.
That's the kind of feeling I get from it.
Sure.
I always go back to the same thing that, I'm an old school guy. In the past, when the economy was good and rates were low and the stock market was going up, everything was good. Now everything's all screwed up and the stock market's still going up. So
I know. I know exactly what you mean. And who cares, right? It doesn't really matter from a day-to-day trading standpoint, but I kind of would like to know for my IRA at the very least,
Well,
and gold, gold, for example, a lot of people say, oh, everyone's going to run to gold. I'm long gold. I have been long gold for a while, but I don't know. Nothing makes sense anymore. All the correlations that we used to see are all blown out of the water this year.
Absolutely. And what Marty says all the time is the old rules don't work. But you can't walk away from the old rules because some of them still click into gear now and then. And so the way I see it, you just have to use everything that you've got at your fingertips to stay up with this. And I don't think it's going to get any easier. It's just going to continue to, be harder and harder, and you've got to have the proper tools. And to tell you the truth, I really do. I like Stottlemyre a lot, so I think that's one of the tools that we also use.
Okay, so some questions from members, and if anybody has any other questions, type them now so I don't have to scroll back and find them. Sorry, guys. Okay. All right, so here's a question. Ryan wants to know: do you look at volume profile for profile charts, or are you looking at TPO, traditional time price opportunity charts? Yeah,
we mainly look at the volume. Because that seems to have been, the stuff that we use on the floor has got some Fibonacci stuff thrown into it. It's got the volume stuff thrown in Stottlemyre. But the key thing that I like about Stottlemyre is the volume levels. I really do. And I know you may disagree with that, but to tell you the truth, Mike, I've never used the whole package completely, and I'd love to know more about it. So, maybe one of these days you can give me a little thing that show me what you're kind of looking at, because I'm always about learning new things. I think that's really important, but that's the volume part of what we look at.
There's a few webinars, by the way, on BMT where we cover that. Okay, so Nathan asks, do you see trading for the retail traders coming to an end within 5 years because of algos?
No, not really. Some people are natural born gamblers, and they've always going to have it in there. They're going to always have it under their skin. A guy like Marty Schwartz, he's turning 75 years old. He's on his all-time financial highs. He's never going to quit. Some guys are going to always be trading. Do I see it as getting harder for the retail guys? I do. But again, I think that with the proper tools, you can you can get around some of this stuff during the day. So, no, I think the retail traders are going to be around a lot longer than 5 years.
Narinder asks, can you tell us how far a stop should be on the ES?
That's a great. Well, that's a loaded question, because that's got a lot to do with how much you have in your account, what your own threshold for risk is on any one given trade. But you know what? As retail traders do it, we're the key thing that we do for a living is we pick levels, and if you pick those levels right, and you're risking 2 or 3 handles in the S&P, you're fine. On long-term trades, like back about, I don't know when this was, Marty had me buy, not held, a bunch of S&P minis. What was it? 1335. 1325 or something like that. It was an old level down there, and he told me wait to buy the S&Ps before they, buy the S&Ps once they flush through the stops. Well, I started buying them a couple handles higher, and what I did was I screwed up my own stop by not being patient and waiting for the level to come into play. But I think if if your stuff works and you're a trader that's in there every day and you've got your own equipment, own things that you use that help you trade, and you're patient enough and you're picking these levels, really, I don't think risking more than 2 or 3 handles is a good idea. If you're setting up a position where you're scaling into something, or scaling up or scaling down, and you're really looking for a bigger move, something where you're going to hold on for 50 or 100 handles or more, then maybe you want to use a larger stop. But
Right.
as scalpers during the day, I think the best idea is to get in and get out. Use your 2, 3 handle stops, and
Well, and if you're going to use an 8 or 12 tick stop, then it's all about timing. It's all about patience, right? You can't
absolutely.
You can't trade in the middle of nowhere.
No.
Speaking of, are you coming to us from the floor right now, or have you already gone home?
No, you know what? I tried to do it from the floor, and that I couldn't get the computer going. And as you know, I've had a lot of problems with these computers. But we do occasionally do webinars from the floor, and we actually did one for a company called LiveVow, because they've got a options platform that I went down to the floor, and we did it from down there. But the thing that I think is important that's about the floor now is if you can get to the right people. And what I say is that if you've got, you wake up in the morning and you've got your platform and you've got your charts, and then you've got CNBC. Whether you're in your room or our room or anybody else's room, what you're really there to be is you're there to be connected to the flow. You're there to be connected to what other traders are thinking. And what I've learned over the last couple, and this sounds funny, but in the beginning when we started MrTopStep, it was all about me. It was all about Danny Riley and the instant message that I had hooked up to over 600 prop firms, hedge funds, and investment firms. And then as the credit crisis beat things up, the list dropped down to about 200, 250, and everybody would come to me for the flow. Hey, we're hitting stops. Hey, this news headline. We did, as I've told you, we had the original SEC Goldman Sachs headlines before they went out on CNBC for about 3 or 4 minutes. So we get a lot of news sent to us. We get a lot of information thrown at us during the day from the floor and other instant messages. But to tell you the truth, and I've said this in my own room, I used to be able to do this and call highs and lows all the time, and I just have this feeling for when they're stopping out, when they're going to get long, get short. But now with all this extra program trading in here, to tell you the truth, I really like being in my room and seeing what other people are thinking, because it seems to me, if you've got having a few really smart heads, combined with me makes my day a lot easier than me out there just trying to do it by myself. So in the room, what we've got a bunch of different traders that point things out to me that help me stay on guard. So, the floor is good. I'm not sure how long it's going to last. In fact, a couple of days ago, or last Friday, I walked. We're directly across from, if we had a camera, I'd show you. But the Board of Trade building, if you come in at 141 West Jackson and you go back, the street behind the Board of Trade is Van Buren, and then the L tracks. We're in a building right adjacent to those L tracks. And right now, if I look up, there's people 20, 30 feet away from me jumping on an L train right now. But across the street is the Board of Trade building where the trading floor is. And last week, I was walking across to go do a video, and there were 2 guys out there measuring the back of the building. And I was like, just curious, but what are you guys doing? And I looked, and one of them had DePaul. He had a DePaul sweatshirt on, DePaul Athletics. And he said, oh, we're from DePaul. We're from the Athletics Association. We're measuring the building to see if this would not fit for an indoor stadium for DePaul. So how long is this going to be around? I don't know. But, what I have learned is that, like threads like what you've got, instant messages that we've got, and again, we try to stay away from all that fuzzy crap where nobody's saying buy or sell, or, you know what I mean? I'm really starting to get a lot more out of my own chat than I ever thought I would. So I think I'm relying more on that now. And we've got to kind of expect things to kind of gear down.
Rachel asks, do you have any idea on the 10 handle range for the S&Ps? Do you have a similar rule for crude?
No, but somebody else did have a crude rule, and I don't have it. But there is a similar crude rule. But we're mainly we hail from the S&P. But I do know that there is some type of rule that they look for, and I what I'll do is I'll look it up. I have it somewhere. I'll flip it to you. But there is a trading rule for crude. Yeah.
Fernando asks if you can briefly explain more about the difference on the premium cash versus futures price.
Sure. There's two types of program trading. There's one that's called index arbitrage, and that's mainly in the S&P 500. That's what they blamed the '87 crash on. Okay, so in the old days when I was doing the big futures in the pit, what we were doing is to do a sell program. You take if you go on, you can get fair value on all sorts of different news websites, trading websites. You get fair value, and that's the fair value is like the cost of carrying a trade that a bank would pay for buying and selling on a program. Okay, so say fair value is minus 550 in the morning. We come in. So what you do is you look at your ES, and you take fair value and you subtract 550 from the current price. And when you get down to that, you subtract that 550 for fair value. To get the S&P lined up to do a sell program, it's got to be $1 under there. So what you can do is you can constantly monitor your levels between the cash and the ES by looking at fair value. Okay, so I don't know I can't tell you what fair value was today, but what I can tell you is that when you get fair value and you line it up against where your ES is, and you subtract fair value or you add fair value above and below, and you subtract. So in other words, let's say the S&P is trading 14. Let's say it's trading 1406. Okay, and fair value is $5.50. So you subtract $5.50 from 1406, you get 1450, right? Well, take another $1 from there, and make fair value minus 650. So when you line up your fair value, what you'll see is the premiums will be contracting and expanding. When your premiums are expanding and it's $1 over fair value and the markets are going up, those offers in the ES are more than likely program offers. So so here you've got the S&P at 14, let's just call it 1405. If I could put it up on a screen, I could do it a lot easier. But what it is, you've got the S&P at 1405, and you've got your fair value. You add fair value over where the S&P is, and you put $1 over that. And what those offers above that $1 over fair value will be your program offers that make up the side of a buy program. And when you're doing sell programs, what you're doing is you're taking fair value and you're going $1 under fair value. And those bids that are in are going to more than likely be lined up for sell programs. In other words, when you're doing a sell program, you're buying cash and selling, no, you're buying futures and selling cash at a lesser premium, or at a wider premium. And when you're doing buy programs, you're offering futures and you're selling cash at a lesser premium. So what you do is you use your fair value, $1 under and $1 over, and basically when the markets are trading under fair value, $1 under fair value, or $1 over fair value, those will give you your levels for buy and sell programs. You know what I could do, Mike? I've got a whole thing I could forward to you, and you can forward to them. It's a whole layout of how it works, but it's very simple. I can tell you the truth. It's something that the ES traders should be looking at all day, because everything is run through the programs.
Yeah, send it to me and I'll post it in the thread.
Sure.
Thomas asks, and Thomas, I apologize, I don't fully understand your question, so I'm going to reword it and hope that I got it right. Do you think that high-frequency trading adds liquidity to the market?
Thomas, it does, but it's debatable of what type of liquidity it's supplying. As we learned in the flash crash, the algorithms and the bids and offers disappeared. So in that kind of case, and like you saw in crude oil yesterday, once these algorithms start to grab on, and what I've always said is what what it'll do is your first wave of sell programs in the S&P, you know, they'll hit some stops out. But if there's really a big cash seller sitting in the S&P and just pounding cash all day long, and you know that there's a big area of sell stops, we know that the algorithms are going to go to those stops. So does it create more volumes when it does that? Yes, but in those blips in the intraday stuff that goes on, I don't know. I don't think that's healthy volume. I think that's volume that is destined to make problems for us down the line. And so far, that's what it's done.
My understanding, and I think that Eric from Nanex said the same thing, is that HFTs really trade against other HFTs.
Yes, they do. Now they are. Yep.
Yeah. Okay. Patrick asks, what kind of options plays do you see the most, or what kind of options do you put on the most?
Well, you know, I like lottery ticket options. You know, I'm be honest with you, I'm not the smartest with my options, but there have been some great trades that we've done after the markets have moved sharply in one direction, and I like buying lotto tickets. We bought some cheap calls going in before the S&P rallied, and we didn't hold on to them or roll them, but there was a play that we made back about 3 or 4 months ago where we bought some calls on a Friday and held them into a Tuesday or a Wednesday, and the S&P rallied like 30, 40 handles. And I think we were paying like 80 cents, $1.50, and we were selling them out at, you know, $15, $20. But to tell you the truth, I'm not really good on my options as far as like strategy setups. But my big thing is I like doing the lottery tickets. If the markets move sharply in one direction, and I think the S&P is basing, I'll go in and I'll buy some cheap calls, you know, that kind of stuff. But I'm not the biggest option trader. My desk does options. Over this, you know, last month we did about 450,000 grain options, and with Marty's crude stuff over the summer, we did about 1 million crude options, and then our S&P options. So we're a big options operation, but I don't want to lie to you. I'm an old floor hack from the futures. If I see something out of whack, or I think that you can buy some cheap calls and hold them, sometimes that's easier to do, you know, than buying or selling 20 S&Ps and hold them. I don't worry about it because I know how much I'm risking. So when I buy them, I just hold them.
Okay. So at this point, webinar is at 2 hours. So I think that we should probably wrap it up.
Yeah.
And I wanted to give you an opportunity to talk about what was on the screen right now, as far as what MrTopStep does, and then we'll call it a day.
Okay. Well, first I want to thank you, Mike. You've got a great company. I wrote all about you in my report this morning. I hope that, you know, we can work together in the future. I'm going to get back to you when we start posting on Yahoo. I'm going to do my very best to give you some free press on Yahoo. I think you really have a great forum here, and I appreciate you doing what you did for me today.
Thank you.
Anyways, on the upper left-hand corner, that's our chat room. And what we do is we've got a lounge for traders that can go in that don't understand the language and talk outside the normal chat room. And then we've got our options room, and then we've got the MrTopStep room. And what we do a little bit differently is I talked to Mike about this back a while ago, and I don't want to name names, but there's a well-known room that had about 400 or 500 people in it, and we like the guys a lot. They're very nice people, but they had one guy in the room that was managing the room, and for about 2 or 3 weeks he was cold, and they lost so much money. I mean, and the traders did in the room, and the guy that was running the room, it tore the room apart. And when I started this, I really did it because I wanted to work with other traders, not just about me, but about kind of what other traders are looking at as the floor transitions. So we built this. This is our technology. This is our chat room. And what we do is we allow our educators, our bond guy, our mini S&P guy, our crude oil guy, you know, we got Marty in there. We've got a bunch of people in there. But we've got, you know, 5 or 6 guys that are in there trading and calling out markets, and that's what they do all day. And what we do is they sell their products. And the way we come up with whether or not we want to work with them is we put them in here. We get to look at their live trades. If they're no good, we don't sell their products, and they probably disappear kind of quick. The room has live charts. It's got audio. and we do a lot of writing. We do a ton of content on MrTopStep. I've written a newsletter for 20 years. I've never missed one day. Even when I was in the Middle East in Dubai, the S&Ps close at 1:15 in the morning. I'd be up banging away on that thing at 1:15 and up at 7 or 8 in the morning going to meetings. But we really believe that content and getting into it and trying to stay on top of it is really a good way. Even if we're not giving you something, new and exciting and hey, this is going to work and this is great and blah blah blah. But we just really stick to our flow in the room, and we've got a lot of good guys in there. The IM chat is a live chat. It's got audio. It's got live charts. We do the live reports. And like you said, Mike, I don't want to oversell this thing. It's not about that. It's about, I think, very similar to what you've got. It's been set up a little differently. It's about trying to help traders. And I respect what you told me when we met. I asked you how you got into this, and you said, look, I got tired of all this crap with all these other places, and I just started to build a site and it built on itself. Well, that's kind of like what we did. But what we've got is we've got just a lot of other people putting in flow. So really, that's really what it is. We've got guys on the floor that we're hooked up to in bonds and currencies. We've got guys off the floor that are running their own stuff, and we just kind of put it all together to make MrTopStep.
Right. Well, I always appreciate. I always try to watch your opening print and closing print videos to get some insight. Always like those, and I know you've been sending me the daily newsletters. Those look really good too. So I think that there's a lot of people that could benefit from seeing your perspective. And I wanted to ask one final closing question for you, kind of a personal question. So I hope I'm not invading your space too much. But
no problem.
With everything you've been through, you've been doing this for a long time. Okay, you gave me a little bit too much credit. I turned 35 this week, so I haven't been around quite as long as you may think. But let me put it this way. I've said publicly on the forum that even when I quote retire, which I hope to do in the next couple of years, it doesn't mean that I'm going to stop trading. I can't imagine me not trading. It's what I enjoy, right? It just means that I don't have to rely on money from trades in order to pay bills, right? What's your goal? You're not going to be on the floor in 20 years. Where do you see yourself? What are you doing?
Well, we're very tied in right now with the web. My focus right now is to continue to build MrTopStep. As the floor winds down, I want to be part of the history making of this, and I don't want it to drift away. We're very, very tied in with Google, and we're very tied in with Yahoo. And hopefully, if we do this right, maybe one day I'll be able to sell the company. But if it doesn't happen that way, I'm like you. I may just drift off into the sunset, trade my own account, not have to worry about all this stuff. But I've done some pretty good stuff with my life, Mike. I've been pretty lucky. I didn't want to, real quick, I didn't want to have to live out in the suburbs and drive downtown. And years ago, I had my girlfriend, now wife, come downtown and look for a building to buy that we could live in. And we were really lucky. We purchased a one-bedroom, a two-bedroom, and a duplex in the heart of the Gold Coast for about $365,000, and it went up to about 1.6, 1.7 million. It's still worth about 1.2, 1.3. And believe it or not, I was lucky and unlucky in some respects. I had a guy come to me back in 07 and 08. He had a printing company that I loaned $200,000 to, and I ended up, when he didn't pay me back, I got a 34,000 square foot factory and a printing company. And I came from a printing background, and we've liquidated a lot of this stuff, but I could see, doing something in the factory, whether it be printing or some type of import-export business. Even at 53 years old and being on the floor like this, I still don't see myself quitting. The other thing is that Marty Schwartz has been after me for the last 10 years to come down and buy a house down in Florida, and I'm sure if I wanted, I could go down and retire and trade with him. But
right.
I also don't want to get thrown out of Marty's house one day because he's mad. So
yeah.
I guess at the end of the day, I think that I'm going to remain in the trading area. But I think as things evolve, I think you kind of got kind of reach out a little bit and start doing some other things. And, you know, there's a great opportunity, I think, in real estate right now. And I'm not saying going out and buying houses and fixing them up and holding them, but I'm saying that if you own a home right now and you're thinking about selling it and buying a new one and fixing it, you know, I don't think the housing market's going to stay as depressed as it's been forever. In fact, I think it's starting to pick up a little bit. So, you know, make some investments and cruise off into the sunset. I love this game, Mike. I'm not planning on quitting it anytime soon.
Right. I hear you, man. And in all seriousness, I also want to give you props. You mentioned that you've done a lot of things in your life. And, you know, I did a lot of research on you before I invited you to come on. And you've seen the other end of some of that research. So I have to tell you that, you know, no, I couldn't find anything negative about you. I've found nothing but positive things about you. And I think that, you know, there's very few of us that are really trying to actually genuinely, honestly help people succeed with trading. There's just a lot of people out there that are kind of, I don't want to be too mean about it, but they're kind of selling false dreams. You know, there's a lot of that, and it really upsets me. So anytime that I find somebody that is not the case, I really try to latch on, to use your word, and hope that we can help each other. All right, man. So I really appreciate your time today. We'll definitely have you back on. And for anyone that's been asking whether or not it's recorded, yes, all the webinars are always recorded. I'll post it tomorrow. I'll send a link to Danny, and he can send it out to his guys.
And listen, Mike, I want to thank you and your crowd, but I want to say one last thing. You know, I don't want to pretend to be perfect. And down there on the trading floor, people take shots at people all the time. What I can tell you is I've always been on the right side of that trade. I've always been defending the customers, not trading in front of the customers. You know, have I ever been in any trouble down there? Yeah, I got in a lot of fights. I punched a guy. I got the first $10,000 fine on the floor. And, you know, I've had my rough spots. But at the end of the day, what I can truly tell you is that I go home at night, and I do believe I try to help people. And my dad tried to do that. My brothers tried to do that, kind of who we are. And I agree 100%. You know, if you're out there selling snake oil, stay away from me. One, I probably won't take your call, but two, after I figure you out, you really won't be getting any calls. I really, really appreciate your time, Mike. And I think that in some shared way, we could probably continue to work together on this kind of stuff. Yep, and it's really all about trying to help people and not see them lose money. That's it.
Yep, I look forward to it. All right, Danny, and thanks, guys, for everyone that's listened to us today. And I'll see everybody on the forum, and I'll be sure and have Danny back a little bit later.
Thank you so much, Michael.
All right, thanks, guys.
And good night, everybody.